I'm joined in the studio by Stephen Nash from Big Securities to help us do that. Stephen, good to have you on board. Thank you. And look, that tender overnight was key, and there was a lot of nervousness yesterday. Triple-digit losses, in fact, on US markets, in some part attributed to the worry about that tender. Just give us some of the numbers and the update on what we actually then got through last night.
Well, there was an expectation of around 250 billion euro that would be rolled on the tender, and it came in at roughly about half that. So it tends to indicate that the European banking system is less reliant on the ECB than that was initially thought.
So better of two evils, I suppose. I mean, they're still reliant on the funding. So people are seeing the positives. I mean, across the market today, people say, oh, everyone's just looking at their negatives. But I mean, look, they still needed that funding. Yeah,
well, I think the market reacted to the Moody's announcement, but to some extent, and has been commented recently, that that's a bit of old news, really, because the other agencies have already moved with regard to the Spanish rating. So
do you think that actually impacted things then overnight, or people just take that kind of thing in their stride?
Well, I think the Moody's news, I think, was an excuse, I suppose, to sell the market. There are other factors that are currently quite important in the US market, apart from the Moody's rating. However, I think the rollover was really quite positive news for the market. It's quite important in terms of having a lower reliance on the ECB. I think that's quite positive. Where
do we see that relief, maybe, or the calm show up? Did you see it in bonds overnight?
Yeah, initially bonds were sold a little bit as people thought things were starting to recover, but then again, of course, as the market came away in terms of equities, bonds got bid once more. We've seen US Treasuries trade under 3%, quite a significant level. It has been lower than that last year, but this nervousness about growth, I think, will continue. Is that seen as kind of an ominous sign? I know a lot of people have been watching that 3% yield for the 10-year Treasury. Do you see it as particularly ominous that it goes below that? I suppose it's just another rate. You know, it's all the levels are important, but there was a psychological or technical level just above 3%, and that broke earlier this week. So the bond market was effectively leading, I think, in a lot of ways what was going on in the equity market, with the 2 years rallying and the 10 years rallying before this sell-off. I think there's concerns on a lot of fronts, and one of them might be this Dodd-Frank bill that's before the House and the Senate at the moment in the US, and it looks as though that bill will, in some way, or one way or another, lead to increased costs, and effectively increased costs for borrowing, and effectively act like a type of monetary policy tightening in the US. So that's fairly significant. Do you think, I mean, the other thing being discussed was this banking levy that the UK has been pushing, and backed by Germany and France. Do you think we'll actually see other developed economies eventually take that idea up? I think that seems fairly popular at the moment. There was a move to put that into the US bill, but that's been taken away. Now, there's still costs that are going to be paid for one way or another, and effectively at the end of the day the consumer will be paying for this regulation. So yes, cost of banking going up. So this is something that you feel that might hang over the markets for quite some time in terms of affecting sentiment? Yeah, the market has to evaluate how important this is. I think the market's coming to the opinion, you know, there will be some sort of European recession, and they're trying to assess whether that will be shallow or more severe. I imagine it'll be on the shallow side. And also the market's trying to evaluate what's going on in terms of US growth. Now, we've had some disappointing results of late, but broadly the US growth is improving. I think we'll see more signs of that towards the end of the year, but in this interim period the market will just be concerned about evaluating the European situation, I think. And in the meantime, people continue to head towards bonds? Yeah, for safety? Bonds to benefit, I think, is the theme, which you guys aren't too adverse to, I imagine. In terms of the global growth factors, I suppose, you know, you've mentioned some of the banking issues. How much do you think the BP oil spill in the Gulf of Mexico has played into sentiment and thoughts about the future of the economic recovery or the sustainability of it? Well, I think the important thing in terms of the BP situation is that it might mean a regime shift in terms of costs for resource companies more broadly, in the sense that resource companies in the past had thought about environmental degradation and they'd paid lip service to it, but now they really have to treat it seriously. So when they treat it seriously, that will mean increased costs, and again, those costs will be borne by consumers. So I think it's leading to a more important change in the way resource companies approach their activities, particularly with regard to environmental issues. So I imagine boards and others will be seeking more detailed procedures on how companies will treat potential risks going forward, and that's going to cost something.
And you've also mentioned the new Bank of International Settlements annual report as something that you think has actually been a recent development.
Yeah, well, what's going on there is the Bank of International Settlements in its annual report has just highlighted, I think, what everyone knows, but there is very limited flexibility in terms of what the policymakers can do at this point. Interest rates are very low. Quantitative easing has been used in some areas, so there's not many triggers left. There is some speculation that what they were implying is that some of the monetary policy easing should be taken back, but I think I don't think that's a possibility right now. I think what monetary policy authorities need to do is give the market confidence in the sense that rates will be left low for as long as they need to be left low.
Here in Australia, we haven't got low rates, of course. We've got some retail sales numbers coming out from the ABS today. Do you think they're particularly important in setting expectations for rates, given obviously the link to inflation? If people are out there shopping, I guess retailers can start to raise prices. If not, you've got less pressure on inflation?
I think they're one of the factors, yeah, of course. Retail sales are an important indicator for the market, but I think there's other indicators that are more important, and the broad problem at the moment is expectations of growth, and they really haven't stabilised at this stage. I think that's going to constrain the RBA right now. I think mortgage
growth globally or domestically?
Global growth, yeah. When those expectations stabilise and start to firm, I imagine that the RBA can resume its tightening. Also, if you have a look at mortgage delinquencies, the RBA has highlighted that they are very low relative to international standards. That's right. But in terms of our history, they are quite elevated. That could be a concern going forward. Just might emphasise that they're not high, but they are high relative to our history. I mean, the RBA has emphasised what the rate of the current borrowing rates are relative to the previous decade. If you look at the previous decade in terms of delinquencies, they are at an elevated level. So,
and you flagged earlier, the cost of borrowing for financial institutions potentially on the rise with that US Senate bill. Do you think that banks here in Australia will be feeling the pressure to the point where they might even start to raise rates if the RBA is on hold, raise their borrowing rates?
Well, we've been looking at the longer-term funding levels for the major Australian banks since the last tightening, and they have widened quite a bit, around 40 basis points. So far, there was a large issue during the week that was priced a little bit higher than expected, which basically indicates, I think there's a lot of... The Westpac issue was slightly higher than expected. I think it indicates that global markets are difficult to place bonds at this stage. The local market will be used in the interim, and the funding costs are going out. And even if the RBA doesn't tighten, there could be pressures on the banks in terms of funding, and that may lead to mortgage rate increases. So
do you think there's a greater chance of mortgage rate rises than RBA cash rate rises this year?
Yep, I'd say that's reasonable. I'm not getting sort of too excited about it, but I think that development, that momentum is in the market already. Yeah,
we've got to be prepared for it. Thank you very much, Stephen. Great to chat to you once again. Thank you.
Okay.
Stephen Nash there from